Hey folks, this is Ruben Lisiaga, Chicago Gold Trader, coming to you live from Chicago, Illinois on Sunday, January 13th, 2013. This is video 4 in the new series of videos for 2013. And I'd like to continue to go over chart analysis and market commentary from last week and what I see what possibly may come up next week in next week's trading. Uh, what you're looking at right now is the longer term um, chart on gold, the daily chart on gold, gold futures GC, and there's basically very little change in the last few weeks in the price of gold. Taking a look at this right now, the price of gold obviously is still weak to the downside as we see our regression channel. We see the price of gold GC hugging that middle mean line right down in the middle. It pops up here and there, uh, right here, right at the toward the end of December. It hit that 1.5 standard deviation back here in November, and again, and toward the end of middle of December, and then came right back to that mean. Right now, as you notice that the trend is continuing to show a lot of weakness. The current price of GC gold is below both the 50-day and the 200-day moving averages, the blue line, the aqua line here. So we again showing that downslide to the downside right here. Um, I covered this the last video. We already we have heavy support down here right around 30, 26, 30, 33, 1633, 1630 area in the gold futures. Um, we are probably building out a small little mini wedge down here. Have to excuse my drawing skills. uh, some of the possibilities for the price to retrace to the upside would be at the 38%, this yellow line, 38% and the 50%. We already hit this 50% again, bounced back down to that floor, and we came back up and we hit that 38% retracement, around 70, a little under 76. It's possible to go back up to 50% at 1690, 1692 area, or we can keep on slowly grinding down under that 30 area, 1630 area, and possibly testing this floor again of 1600. Possible targets to the downside remain approximately the same in the last couple of weeks, 79 and 51 on the short side. These are Fibonacci price extensions to the short side. As taking a look at this, we have a lot of activity ever since this past summer in this area right here. Under 1640 to around 1560, 1580 area. Tremendous activity. Again, that it's possible that we could test to the lows. It's taking a look at volume. Right now, volume doesn't really give us a lot of heads up on what could be happening. We have a lot of sellers coming in at these top spikes, and a lot of weakness on the longs. Lots of weakness. If you take a look at these, my drawing here, and this has been going on for a couple of months now, but you see that the sellers have a lot of strength, lots of strength, a lot of strength here. So I would say in general you want to stay with the short-term trend, which is bearish, and ride this baby down until the trend actually turns around. We don't know when, but if I can give you a quick heads up, the commitment of traders, the commercials, taking a look at this real quick, they still remain short. This red line here, they still remain under the zero line. They remain net short commercials, which are the big boys in gold. The hedgers are hedging their bet. Usually they're the same folks. So this is a very good indicator that that they want it. They're going to push this thing, keep on pushing gold, price of gold to the short side, and hedge their bets in case something happens, some type of uncertainty to the long side, which will push the price of gold up. So again, this is a very good indicator as they're opposites of each other. The only caveat here is amateurs, the blue line here, as they are on the same size as commercials. So, and we know that from history that amateurs are always wrong most of the time. So this is probably not a conclusive, substantiated indicator right now because of amateur. The amateur are also net short. If the amateurs were up here above the zero line, then that would be a very conclusive indicator. But as we see, they're both net short, commercials and amateurs. And speculators are opposite of commercials. And like I said, most of the time they're one and the same. They're just hedging their bets. So they're pushing it down, but in case something happens, they're going to make money on the upside anyways and get out of their short covering. Okay, so with that being said, look for the price to continue the regression channel down this mean. It's very possible that we get a confluence here at somewhere under 1630, and we see the price bounce back up. Very possible. We'll keep our eye on commercial traders, keep our eye on volume to see if long start stepping in. We don't know at this point. Let's take a look at the S&P. Also on the daily chart, longer term daily chart. This is the ES contract. And taking a look at, again, the price of the S&P hit that mean line toward the end of the 2012, hugged it, then we had that huge drop a couple of weeks ago, pop right back up, hit that mean again, and it's heading in the short-term trend on the S&P, and the ES contract, futures contract, is bullish right now, at least on the short-term side. Now, we have heavy resistance at this area. We're at all times, we're at 5-year highs on the S&P for the last 2 weeks in a row. I really can't see it. It's right now the trend is bullish. It's true, but it will take a lot to keep this the rally moving to the upside. The next possible targets, are at 1522. Right now, the ES contract in the overnight market is trading at 1463.5. So again, hugging that mean line, heavy resistance. Looking for the S&P to possibly, very likely, it may hit to the downside. It may keep on going up temporarily, but sooner or later, it's gonna run out of steam and start coming back down. It always does. And we have a lot of retracement targets to the downside at 38%, 23% at 1438. 38% at 1418, and then 50% retracement, very popular, right around 1400. So we have a long way to go, but it can drop, as we know, tremendously in just a few days. The average true range of ES is around 17 points or so on a daily basis. So it could move 17, 20, 18, 19 points in one day. So in a couple of days, we'll get down to these lower levels, lower Fibonacci levels that I keep on referring to. Also, take a look at this. We had a lot of weakness in volume to the downside. Trend is down. A lot more reds, more sellers than buyers. So this is a very good indicator that as the price of the S&P and the ES contract keep on moving up in the green bars here, it's very low. It's supported by very low volume, which means weakness, which means the price will come back down. Very likely. Also, like I said, here's your targets. Now, the other thing I put up here was the price of a 30-year bond, because in general, the 30-year bond is opposite inverse of the S&P, and this will be the light blue or the aqua bars. Okay, if you take a look at this, the price of and the direction of the bonds is to the downside. How much further will they keep on going down? We have a lot of support there, and I see it's very possible that if the bonds hit this floor again, this heavy activity at this level, it will push the bond price of bonds up, and then that would cause the S&P equities to come down, and that's very normal, very expected, and that would help push the S&P down and cause a sell-off. So again, the 30-year bonds, Treasury bonds, are at their lows. Will they bounce up? It's who knows. They can. They're very likely. Keep your eye on it. I would just not. My point is right now, I would not stay in the market on the S&Ps or the ES contract for very long. Right now, the trend is up. Go with the trend. But at any moment, any day, any week, it's going to run out of steam. As bonds push back up and the equities start coming back down to meet these retracement levels. Again, lower volume. As the price keeps on pushing up that mean, that regression channel, based on lower volume, which always means the price is going to come back down on low volume. You're looking for spikes. Spikes, like green spikes, for the longs to come in, and I don't see them. They haven't had none for a few weeks now, and then a lot of them, a continuous series of spikes, of green spikes, hasn't been seen until around June-ish of sometime last summer, June of 2012, and then maybe a little bit earlier in the year, maybe a couple little spikes here, back in September-ish. There's a little spike here in probably early November, and that was about it. So I see a lot of weakness, but anything can happen in the markets. Okay, all right. Enjoy the Southside Blues. You have a great week. I'll try to do more videos. I'm going to try to bring in the Treasury bonds on an individual chart and critique them and give them my commentary, just on the 30-year bonds themselves without the ES. So I'm looking to do a complete chart analysis on gold, U.S. Treasury bonds at 30 years, and the S&P and ES contract. You guys have a great day. I'll see you on YouTube, Facebook, or on my website, ChicagoGoldTrader.com. Thank you very much, and I'll see you next time. I got the come true.